This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Lucky 7, the Dow keeps its win streak alive. Is the summer of calm overseas helping U.S. investors?
Historic vote. Workers at a Mississippi auto plant are deciding whether to unionize as the UAW tries to make a big push into the South.
Pricing pressure. Generic drugs are getting cheaper, and that's creating a barrage of bad news for the biggest player in the industry. Those stories and more tonight on Nightly Business Report for Thursday, August 3rd.
Good evening, everyone, and welcome. The Dow eked out a gain, just a little one, but it was good enough for a record close. The index's seventh straight. Stocks did see a slight pullback late this afternoon on a report that special counsel Robert Mueller has impaneled a grand jury in that ongoing Russia investigation. But the pullback in the stock market was small, and the market, for the most part, did what it has been doing, ignoring the drama down in D.C. The final numbers look like this. The Dow Jones Industrial Average rose nearly 10 points to 22,026. NASDAQ off 22. The S&P 500 fell 5. Now, while the markets were mixed today, the trend has been higher. But what has been driving stocks? There are a few schools of thought, and one is that the global economy is strengthening, the outlook upbeat, and that Europe, for a change, is having a crisis-free summer. Bob Pisani looks at how U.S. investors are being helped by markets worldwide.
The global markets are improving because the global economy is improving. Europe is in the middle of an economic turnaround. The Spanish stock market is up 12%. Germany and France up nearly 6%. They'd be up even more if it wasn't for the fact that the euro's been rallying big time. That makes exports more expensive for European companies, many of which are German. So the German market, while it's up, is still 6% off its highs of 2 months ago. Emerging market economies have also improved. South Korea, Vietnam, Philippines, Indonesia, they're all up double digits this year. And the Chinese economy, despite concerns about government-mandated crackdowns on credit, has stabilized. Hong Kong's up 25%. Stocks have been rallying this year because the global economy has been improving and corporate earnings have been improving. Earnings for the S&P 500 companies are expected to be up 11% for the second quarter. They were up 15% in the first quarter. Stocks trade off of future earnings prospects. That's what's helping. You could see this in the rally for the Dow. 5 stocks were responsible for almost all of the 1,000-point gain that we saw in the Dow recently. Boeing, McDonald's, Apple, and Caterpillar. 4 of the 5 have more than 50% of their earnings overseas. That's not an accident. Only United Health did not. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So how is the economic and financial stability that we're seeing in Europe this summer helping the U.S. market and investors? Jeff Kleintop is the Chief Global Investment Strategist at Charles Schwab, and he joins us now to talk more about that. Always great to see you, Jeff. Welcome back.
Thanks, Sue. Thanks for having me.
I was looking at one of your notes that you sent along to us, and it really is amazing. It says all of the world's top 20 economies are on track to grow in 2017, and that Europe is having a very crisis-free summer. It wasn't that long ago when we were worried about Greece and we were worried about Portugal and Italy and the like. It's all changed dramatically.
It really has. And one of the other things that changed around the, let's say in the maybe spring of this year, was the concerns about politics. You know, at the beginning of the year, the thought was, well, we know where U.S. politics ended up, but Europe had a number of pivotal elections in the first half of the year. They all went for the status quo. No major change there. So the outlook on political risk, always something that's been simmering in Europe, has actually faded as well. So economically, politically, and from a financial stability standpoint, things are working on all cylinders for Europe.
A lot of Americans, Jeff, as you well know, are underinvested in international equities, and maybe particularly in Europe, given the troubles that Europe has had. Give some advice on that.
Yeah, it's very true. Everywhere I go, people are very focused on their home market. They find that's the best place to invest. This year, I guess performance speaks for itself, right? The Euro Stock 600 index is up 18% in dollar terms. What an amazing return for U.S.-based investors. Missing out on that would certainly be disappointing after so many years of seeing relatively lackluster performance in Europe.
Is it too late to invest there?
Great question. No, I don't think so. What we're seeing is very strong earnings growth. Remember, there have been a couple of recessions in Europe since the last one in the U.S. They're earlier in their business cycle and earnings cycle than we are here. earnings, more upside there, I think, and certainly stocks have not yet gotten back to their peaks in Europe either, or close to their peaks in many of those countries. They have a bit more to run. Valuations also a bit lower, Tyler, so there's more opportunity there.
You also make the point that Europe, in general, I mean, every country certainly is different, but Europe generally is overweight the financial sector compared to the U.S., which tends to be more overweight of technology.
That's right, and it tends to define the performance of those two different major regions. We've started to see the financial sector come back and begin to perform. In fact, it's the best performing global sector over the last 3 months. Tech's still done well, but financials have edged it out on maybe rising longer-term interest rates. If that trend continues, and we think there's reason to believe it may, that's great news for Europe outperforming, or at least maintaining this level of performance relative to the U.S. over the second half of the year.
How does a weaker dollar help American investors?
Well, it's a wonderful thing in that when you're returning money made in euros back into dollars, it buys more dollars. So, for example, the Euro Stoxx 500 index only up 5% in euro terms, but 18 in dollars. The good news is there's no downside to that. So Bob Pisani talked a bit about the threat to imports it may have, having a higher valued currency in Europe. But the fact is Europe only has about 16% sales exposure to the U.S. So a relatively small portion of their sales are to the U.S. where their currency is really appreciated. So I don't think it's going to be a big hit to earnings. Instead, just a real positive for U.S.-based investors.
Jeff, thank you so much. Appreciate it. Jeff Kleintop with Charles Schwab.
One of the issues lingering over the stock market is the debt ceiling, which the Treasury warns will be hit in September. Today, the White House budget director told CNBC that the entire Trump administration supports a so-called clean debt ceiling increase. That is, without spending cuts or other stuff attached. But at this point, it's not clear whether Congress agrees with that. In that interview, Mick Mulvaney also said that the administration will not raise taxes on wealthy individuals.
It looks like the services sector may be cooling off a bit. The Institute for Supply Management said non-manufacturing activity grew slower than expected last month. The services sector accounts for more than 2/3 of the U.S. economy. Meantime, in the manufacturing sector, new orders for goods recorded their biggest increase in 8 months after 2 straight months of declines. Motor vehicle production weighed on factory activity as that industry struggles with falling sales and an inventory glut.
The labor market is getting tighter. The number of Americans filing for unemployment benefits fell last week. Initial claims for jobless benefits dropped 5,000 to 240,000. That's near a 44-year low. Tomorrow, the government is expected to report that the U.S. economy created 180,000 new jobs last month. And against the backdrop of that strong labor market, the president yesterday endorsed a Senate bill that would sharply reduce the number of legal foreign immigrants entering the U.S. The reasoning, in part, is the theory that immigrant workers, especially low-skilled ones, depress wages and take jobs American workers want. Here to discuss immigration and the economy is Chris Varvaris. He's co-founder and senior managing director at Macroeconomic Advisors. Chris, welcome. It is a complicated issue, a thorny one indeed. But you would think that when the economy has 6 million open positions and really full employment at 4.4%, that you would want more workers to come in to take those jobs and help economic growth.
Yes, you would. You would think that. And certainly when we look at the skill gap and the high-skilled jobs that are available and going wanting for workers, anything that would allow high-skilled workers to enter in greater numbers is good for the economy. And all reform proposals that have considered this in the past find results that is very positive for the economy. On the other hand, on the low-skilled side, I think the evidence is mixed. It's not clear what happens to wages when you allow many more unskilled workers in. It increases demand for goods and services in the economy, which puts in additional demand for workers. So it's not entirely clear that domestic workers are displaced in that situation.
Mm-hmm. You also make the point that it would change the ratio of workers to retirees, which also changes basically the workers paying taxes to support some of the social programs.
Right. So underneath this notion of fewer immigrants coming in is the notion that since they tend to be younger than the indigenous population, that as we roll forward and we see the baby boomers retiring in ever greater numbers, the number of workers per retiree is going down. And to the extent that we have greater immigration, that improves the ratio. We'll have more workers per retiree. So cutting immigration is sort of swimming upstream with respect to how we're going to fund the retirement and Medicare costs for ever increasing numbers of retirees.
You've looked at some numbers, done some modeling, Chris. What would cutting immigration to the extent, legal immigration is what we're talking about here, to the extent that this Senate bill that the president endorsed, at least in part yesterday, what would it do to overall economic growth?
Yeah, well, the arithmetic is pretty simple. You know, sort of abstracting from a bunch of things that could change this number just a bit. Legal immigration is roughly half of total population growth today. We're growing at about 0.8. If you cut the immigration part in half, you're talking about 0.2 of population growth coming out of the economy, and that would tend to drive about 0.2 of real economic growth, real growth of GDP. So if you cut legal immigration in half, you're going to knock about 0.2 off the growth rate of GDP. Doesn't sound like a lot in any given year, but every year it lowers the level of GDP by 1%. 25 years, the economy's 5% smaller. Which
changes our ranking globally, I would think.
It well could, and when you think about, say, our defense budget as a share of GDP, and other programs that we want to fund out of the economy, it's something that needs to be taken into account.
Chris, thank you so much for your insights tonight. Chris Riveras with Macroeconomic Advisors.
And sticking with the issue of labor, tonight some Nissan auto workers in Mississippi are voting on whether or not to join the United Auto Workers Union. The outcome of this two-day vote could be historic, since the UAW has never unionized an entire assembly plant in the Deep South. Phil LeBeau has more on the vote and what it says about organized labor in America.
It's voting day for 3,800 Nissan workers in Canton, Mississippi. Their choice? Join the United Auto Workers or remain independent. The UAW says Nissan workers are looking to ensure greater pay and benefits, especially for temporary workers hired by the automaker.
The discussions I have had with workers in Canton, Mississippi at Nissan, they're all concerned about the temporary workers. They all feel for them, right? So if they really want to do something down there, the first step is to vote yes.
But the UAW has long struggled to connect with auto workers in the Deep South. Yes, it represents some employees at the Volkswagen plant in Chattanooga, but in general, the Deep South remains union-free, partially because it's filled with right-to-work states, and many blue-collar employees in those states have never felt compelled to join a union. A spokesperson for Nissan thinks that's still the case, saying, "We do not believe the UAW representation is in the best interest of the employees of Nissan Canton." Meanwhile, after the Big Three shut down facilities and laid off thousands of workers during the recession, the UAW is a far smaller union than in the past. In fact, since 2004, when it represented more than 650,000 workers, the UAW has lost more than a third of its membership. The vote in Mississippi will run through Friday night. If the UAW wins, it will begin the process of negotiating a new labor contract with Nissan, something the Japanese automaker has never dealt with here in the United States. Phil LeBeau, Nightly Business Report, Chicago.
Still ahead, Teva's troubles. It's cutting jobs, its dividend, its earnings outlook, and the stock tumbles more than 20%. The Senate today passed legislation to ensure that there would be no halt in FDA reviews of drugs. The measure increases the user fees that drug and medical device makers must pay to the agency. The revenue raised would help pay for government reviews to bring the company's products to market. The current law governing these fees expires at the end of September.
Generic drug prices are falling, and that is taking a toll on a number of companies. Drug wholesaler AmerisourceBergen is one of them. It saw profits tumble more than 85% in the most recent quarter. It also cut its revenue growth forecast and added that the pace of branded drug price increases could slow further as well. The pharmaceutical supply chain, which includes pharmacy benefit managers and drug distributors, has been under pressure due to scrutiny over rising drug prices. Shares of AmerisourceBergen fell more than 10% in today's trading session.
Meantime, the world's biggest generic drug maker, Teva Pharmaceuticals, reported a steeper than expected drop in profit and cut its dividend 75%. The reason, those stubbornly low generic drug prices here in the United States. Shares of Teva down 24%, and that dragged shares of some rivals lower as well. Meg Terrell has more on Teva's troubles.
With all the focus of the high cost of prescription drugs in the U.S., it may be surprising to hear that it's the opposite problem weighing on one sector of the industry. Generic drug prices in this country are under intense pressure, cutting into the finances of their manufacturers.
We're on an arc that's slowly declining now.
Israel's Teva Pharmaceutical today was hit hard. Its second quarter results included a $6 billion charge based on the state of the U.S. generic drug market. Its interim CEO told investors, quote, "All of us at Teva understand the frustration and disappointment of our shareholders in light of these results, pledging to cut costs and pursue the sale of some units." Teva also lowered its full-year forecast for sales and profit and cut its dividend by 75%. Other makers of generic drugs are feeling the pain as well. Mylan's stock was under pressure today, and Novartis's Sandoz unit, which already reported results, reflected the same dynamics. Wells Fargo analyst David Maris says there are multiple forces at work.
The buyers just got smarter, and so they're coming back and saying, we want to reprice, not just once a year, but maybe even twice a year. So that's one part. The other part is you're seeing that other Indian generic players, other players are coming into the market, and the FDA has done a really good job. They see this giant backlog. They've committed to clearing out the backlog. Well, so when they approve more generics, it's not that they're approving the first generic. Sometimes they are, but a lot of times they're saying, well, high prices are caused by limited competition.
The pressure on Teva comes around the anniversary of the closing of its $40 billion acquisition of Allergan's generic drugs unit, which made Teva the largest company in the space.
On top of that, the Israeli drug maker is also seeking a new CEO. It'll be a big job for whoever takes the role. For Nightly Business Report, I'm Meg Terrell.
Aetna lifts its full-year earnings outlook, and that's where we begin tonight's market focus. The upbeat guidance followed the health insurer's stronger-than-expected quarterly profit and revenue. Aetna, which has exited most of the Obamacare insurance markets, said the results were helped by less exposure to the exchanges, as well as an increase in Medicare membership. While the company has no plans to re-enter the Affordable Care Act markets, it could under the right conditions.
Any business that has the kind of changes this program has seen quarter over quarter, sometimes monthly, would not be able to sustain their business practices for any period of time. So when they get it right, which it can be fixed, it very much can be fixed, and it's stable, we'll reconsider participation.
Shares rose more than 2% to $158.54. Avon reported an unexpected loss and said its CEO would resign next year. The cosmetics company, which is in the midst of a turnaround, has been struggling to lift sales, and the most recent quarter was no different. Overall revenue fell due to weak demand in a number of its markets. The company also said it expects to meet the low end of its full-year outlook. Shares plunged nearly 11% to $3 even. Last night, we told you that insurance giant AIG reported better than expected earnings. Well, today, the company said it will no longer provide guidance on financial targets. It also said it would do away with a previously announced capital return plan that was intended to pay shareholders $25 billion by the end of this year. AIG said it will still return capital to shareholders, but will not target a specific amount. The shares rose slightly to 66.06.
The snack and beverage company Treehouse Foods said it would cut about 2% of its workforce in an effort to cut costs. The company will also close 2 factories in Minnesota and Indiana. Treehouse said the layoffs will affect nearly 400 employees. Shares of Treehouse Foods got crushed, falling almost 12% to $74.16. Cost cuts helped Kellogg top analyst estimates for profit and revenue. The maker of Eggo waffles and Pop-Tarts said it was helped by higher sales in Latin America and Asia, even as demand remained weak in the U.S. The company also completed the shift to its new snack distribution model earlier than expected. That sent shares higher by 4% to $70.36. Viacom reported better than expected quarterly revenue thanks to higher affiliate fees. That helped offset a continued decline in U.S. ad sales, the company's 12th consecutive quarterly drop. Viacom is the owner of MTV, Comedy Central, and Paramount. Shares still initially fell in after-hours trading, but they ended the regular day up nearly 3% at $35.07. And Kraft Heinz, after the bell, reported a 50% rise in quarterly profit thanks to cost cuts and increased demand for some of its sauce and condiment products. The company is backed by the billionaire investor Warren Buffett and the private equity firm 3G. Shares were volatile in the extended session, as you see there, but they did finish the regular day down fractionally at 86.51.
Mortgage rates are holding steady below 4%. Freddie Mac reports the rate on the 30-year fixed inched up just slightly to 3.93%. Mortgage rates have not risen substantially despite the Federal Reserve having increased its key interest rate 4 times in the past year and a half.
Despite the strong housing market, sales of luxury homes had been lagging. That is until now. Diana Olick takes a look at what's behind the new boom in top-of-the-line real estate.
The trouble with these super expensive homes was, well, they were too expensive. Luxury home sales and sale prices had been lagging the rest of the market for the past few years, but now they've turned around for one simple reason. Nope, not that, although it didn't hurt. It's really this.
Luxury sellers are getting back in sync with reality, which is something that's been lacking for the last several years. Buyers simply won't come up to meet their number.
Sellers lowered prices, buyers came back, and now for the first time in 3 years, luxury home sale prices are seeing bigger gains than the rest of the market. This according to Redfin, which defines luxury as the top 5% of the market's most expensive homes. Again, because sales are up 19% in the $1 million plus range, according to the National Association of Realtors. All those sales caused the inventory of $1 million plus homes for sale to drop over 9%. That after growing for more than a year.
What we're seeing is inventory declining, but that's really listings expiring that were significantly overpriced to begin with, something that I call a phenomenon, aspirational pricing, where they set numbers that had no connection with reality.
Despite the gains, the luxury market is not nearly as competitive as the rest of the market. Only 1 in 50 luxury homes sold above list price in the past 3 months. Compare that to more than 1 in 4 homes in the rest of the market. For Nightly Business Report, I'm Diana Olick in Washington.
Coming up, we are raising a glass to the pink wine that's red hot.
Retirement account balances, they're hitting new highs. According to Fidelity, the average 401k balance reached more than $97,000 in the second quarter, up 9.5% from a year ago. The average balance for individual retirement accounts is now more than $100,000. The results are due to a stock market that is near record levels, as well as increased employee and employer contributions to those accounts. It is the third straight quarter of record balances.
Well, everything seems to be coming up rosé. Sales of the pink wine have skyrocketed recently, and its newfound fame is making it one of the most powerful forces in the beverage industry. Seema Modi raises a glass in New York.
Once referred to as cheap and unsophisticated, thanks to smart rebranding, rosé wine is in fashion, quickly becoming the quintessential drink of the summer. Astor Wines, the largest wine and spirits store in New York City, has been increasing its rosé selection, currently with 75 still and 50 sparkling rosé offerings.
We're going through a peak right now, and there's also a great variety of rosés, different styles, different colors, and people just want to try new rosés.
Sales are up 60% over the past year, more than Prosecco, Cabernet, Pinot Grigio, and Chardonnay, according to Nielsen research. It's become so popular, Wolfer Estate Winery, 100 miles east of here, ran out of their signature Summer in a Bottle, but they have other rosés available. What's behind the strong demand? Well, think pink. Industry experts say it's the color, packaging, versatility, and price, typically cheaper than champagne. And in a very modern twist, social media buzz has also contributed. The use of catchy hashtags like YesWayRosé have been widely prevalent on Instagram, so much that two millennial women, Erica and Nikki, started their own retail brand selling rosé-inspired apparel and accessories.
Every summer we double our sales, so that's a good trend. Key customer is women mostly.
And experts say as rosé wine evolves with new blends and offerings, demand will continue. For Nightly Business Report, I'm Seema Modi in New York.
Maybe we
refreshing
should
rosé sounds pretty good right about now.
Right
Doesn't a
about
little
now.
sparkling? I never had sparkling rosé. I'll have to try it.
Oh, we'll have to go try it. Because now it's time to say goodnight. That's it from Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Matheson. Thanks for me as well. Have a great evening, everybody. We'll see you back here tomorrow.
Raise a glass.
After our rosé.
Yes.